Welcome everybody. I'm here with the CEO of Safka, Tanya van Lill. Tanya, thank you for being here. I would like to explore, especially with the hat that you're wearing here, where you have a lot of members from private equity to venture capitalists to family offices and so forth. You have seen a lot of what works and what doesn't in terms of the work that these investors are doing. Can you give us a little bit of a sense of the work that you do and the kind of mandates and the kind of work that your members do?
So Safka advocates on behalf of venture capital private equity fund managers, on behalf of our members. And we do this by engaging with regulators, policymakers to create a more supportive regulatory environment for them to do business in. We also do research, events, training to help with capacity building and promoting private equity and venture capital as an asset class. Because just like any entrepreneur, our members also have to raise funds in order to be able to invest those funds. So we need to do what we can as an association to support them in their journey to raise funds, to ultimately invest those funds in the companies that they invest in. And that's the fundamental purpose of why Safka was started over 22 years ago, is to provide that level of support, voice and advocacy on behalf of our members.
I would like to touch base on that because the space in which your members, I guess, play in is actually crucial as an enabler for an ecosystem to grow. What are some of the mistakes, now without mentioning names, but what are some of the things that your members do well and some of the common mistakes in terms of raising funding, in terms of starting a fund?
I think if we look at some of the trends that I've seen the last 3 years being in the industry, is that it takes them much longer to fundraise. They underestimate the cycle. Previously, they would fundraise, if they raise a new fund, 6 to 12 months. Now it can take up to 18, 24, maybe even 36 months to just raise a fund. It's very difficult in the South African context to raise a fund because you firstly have to sell the South African narrative before you even sell private equity or venture capital as an asset class. So we need to sell the country as an investment destination over and above the multiplier effect and the great things that the asset class can do for the economy. We have to sell the region. So internationally, funders who invest in private equity and venture capital funds are firstly looking for good returns and then secondly for a positive impact. The impact is there, but can we match that with the kind of returns that they see in US and Europe? So those are some of the challenges that our members are facing, and they underestimate the time it takes to raise funds.
On that, let's say it takes 24 months, whatever the period is, on what basis do they raise funding on? Because the pipeline kind of dries out after 24 months. You almost have to reinvent the pipeline of potential businesses to invest in.
It's a very fine balance between courting that pipeline and keeping that pipeline and raising your fund. It's very important for them to justify in terms of what their investment mandate is and what sets them apart from everyone else that's also raising funds. As a region, South Africa or Southern Africa competes for cash and capital with East and West Africa, as well as any other emerging market that can offer the same kind of levels of impact that we can. So it's very important to have that narrative and the positioning of what sets your fund apart from everyone else.
On that, in your experience, a new fund, whatever the structure that has been chosen, start small, very niche and focused, and then grow on that, or go big and try to raise a lot of capital?
If you have the experience, you have the networks, and you've got the track record, go big and raise a lot of capital. But we see a lot of the fund managers that are starting out are a lot more niched, smaller. Start with smaller teams because they've got specific areas or expertise in industries, and they create the investment thesis around that value that they can add to those industries and experience that they've garnered in previous deals that they've been involved with.
And in terms of, if I may ask, cooperation or go at it alone? So for example, I wanted to start a new fund in healthcare, for example. Should I go to an existing fund manager who has got the reporting, the due diligence, all that infrastructure, or is it better to go on your own?
There's merit in either. If you have the kind of working capital to go at it alone, and you've got the skill set to set yourself apart, I would say go at it alone and walk that journey. But it's a long, lonely journey.
Yeah.
If there are partners that you can collaborate with, rather collaborate than reinventing the wheel. If there are potential partners, see where their potential gaps are and how you can fill those gaps rather than starting from scratch. It is a really hard slog to start from scratch.
And is it too much capital? A lot of sort of events and articles that I read are suggesting that there's actually a lot of capital out there, but very few really investable businesses. Is this the case?
I think it's finding the balance between the investable businesses. If you look at the life stage of a companies, the very early stage companies where venture capital invest in, they'll always say not all the businesses we look at are funding ready, and they don't always need the funding. They need other things: mentorship, expertise, access to market, rather than the funds.
Yeah.
But when you go up the life cycle in terms of a business where it's a more growth or maturing kind of business, you'll see that the needs there are different. So it really depends on the life cycle and where that business, why they require the investment. And I think that's a big portion of making those decisions in terms of whether to invest or not invest, whether to partner or not in partner.
You have a big network. I don't know how many members are there of SAFCA, but there must be a lot of knowledge shared across all of them. Are people open to sharing, or is it very much, my experiences, my learnings, keep them to myself because that's my IP?
I think there are certain aspects that are their own IP. That would be, for some of them, they see it as their secret sauce in terms of how they create value or how do they identify the right deals.
Right.
So some of those things are specific to the fund manager. But I have found, and I see it in our conferences and our training, that people are open to sharing and collaborating and very collegial to talk about lessons learned. So there is this sense of collegiality, and the sector is still growing, and it's still a sector where most people get to know each other. So your ally today might be your the person you sell a deal to tomorrow, etc. So you really need to keep those relationships going, and the best way of doing that is to cultivate trust through sharing and knowledge exchange.
That's actually a very powerful message that you're sharing there, and it's not everybody's competing, but there is maybe a fund which focuses on very early in a specific sector but requires for the next stage to partner with somebody else.
Or you may have to co-invest. It might be that the nature of the investment or the project is just too big for you to write a certain check size. So you need co-investors to come in with you. So you need those partnerships.
To the risk of putting you on the spot, and you can tell me to delete the video afterwards, but what are some of your frustration that you wish you could shake with your members, especially new members as well, around the work that they do? In also, because I know you from the business school days, and you have a heart of gold, your passion to helping entrepreneurs, the economy to grow is unparalleled. What do you wish you could insert into your members' heads?
Well, one thing that we always struggle with is getting good information and data from our members to help amplify our research and the work that we do for them, to help promote and advocate for them. So it's definitely to share the success stories with us. Because if each of our members invest in 8 to 20 companies, and they've got success stories out of all of those companies and rich data, share that data and that information, because when aggregated, the amount of impact and positive multiplier effect that our members actually have on the economy is understated. And we need to be able to advocate more for them, but we need those proof points. And without those proof points, it's very difficult for us to do what we do.
If you didn't exist, what would happen to all these organizations? How is the coordination to the benefit of the country's growth? Would it be lesser, or where do you find the value? And I think where I'm asking with this is especially organizations around the world or governments who are watching this and saying, okay, should we set up a body like SAFCA to push or to steer or to share more knowledge?
I think if SAFCA didn't exist, each and each and every one of our members, and there's over 130 of our members, if there was a policy change, each one of them would have had to make a submission and go to Treasury or the financial regulator to advocate for each of them separately. So I think that burden in itself is what SAFCA assists and aids with. Each one of them would have to do the necessary research to be able to say, what does the state of the industry look like? What is the sheer size of the industry? Where are the sectors that this industry is investing in? Which would make it very difficult for them to capital raise specifically internationally, not only locally. And also, they would have to separately go out and engage with not only regulators and policymakers, but also with the service providers in terms of the value that the service providers can offer them as an industry.
And maybe, and feel free not to answer this, but for other institutions looking at this and they're saying, okay, we like this idea of a, let's call it central coordination body. How do you sustain, what is the, I don't want to say business model because I think you're driven more by impact, but what is some of the advice that you've learned through running this organization regarding sustainability so that this can last 20 years and it's not a just one-off initiative?
Well, as a non-profit, we have to ensure that we cover our costs. And we do that through our membership fees. And we only get membership fees and we get applications for memberships if we can show the value to the members. So even though you're a non-profit or you're an industry association, run it like a business and make sure that you've got a value proposition for your clients or your members as you see it. Do not run it as a non-profit. Run it as a business in terms of revenue, cost, value that you offer your customer and your product line. Run it as a normal business, and as they say, if you build it, the members will come.
Tell us about your product line and value proposition as SAFCA.
Product line, training, events, networking opportunities, connecting investors with the fund managers, connecting them with the latest thinking and research and information, making sure they're up to date, making sure that any policy changes are supportive rather than negative to their businesses and the businesses they invest in, and ensuring that SAFCA remains at the cutting edge of what's happening internationally, but making it locally relevant.
And of course, hire the best CEO that you can find. What are some of the biggest surprise you personally have had in entering the sort of this venture capital and private equity space?
I really thought it was, and it might be like that in the boardroom and when deals are on the table, it was very cutthroat. What surprised me most is the collegiality and the sense of warmth in the industry itself and how people want to nurture and grow this industry and their passion for this industry and not just their individual funds.
If I can ask as a parting shot to, I don't want to say speak for all your members, but what is the biggest frustration your members have with the entrepreneurship population and business population out there that is frustrated in not being able to get funding?
I think it's the perception that our members are, one, unapproachable or do not want to give them money, but it is really about alignment and making sure that if you understand the world of the members, you'll understand better in terms of their allocation and where they can and can't allocate to. I think a lot of people have this perception that VCs don't want to allocate, but if you think about the venture capital sector in South Africa, it's still young, it's still small. You can't compare it to a Silicon Valley. We don't have enough VC fund managers and they don't have deep enough pockets to make multiple investments and multiple rounds of investments. It's still a growing sector. So instead of saying VCs don't exist or they don't want to invest, maybe understand the world that they come from and that they also have to raise funds, have investors that they need to keep happy, and need to make responsible investments to ensure that their returns to the investors are marketable.
Absolutely. And I guess in that lies also this alignment between what the entrepreneur, the business owners and so forth are trying to do, the exit strategy, and the investors' exit strategy.
Exactly.
Tanya, thank you so much for your time.
Thank you.
Really appreciate it.
Appreciate it.
Thank you for watching.